Welcome back, Bill.
Thank you.
Now, I understand you're going to talk to us about average true range. And I know Dr. Elder actually talked a lot about this for setting stops at ChartCon. So I'm interested to see what you've got to present to us.
Yes, exactly. I was lucky. First of all, congratulations to both of you through getting through ChartCon. It was great fun to see you again. Um, I got to sit through some of the presentations, which I always love doing. And then while everybody was off last week, I had some time to catch up and look at a lot of the recordings, not all of them. But like you mentioned, one of the things I noticed, of course, the theme of ChartCon 2018 was dealing with risk. And I noticed Dr. Elder and Arthur Hill and at least maybe one or two others started talking about using average true range as sort of a gauge or a proxy of risk. And I started kind of looking into it a little bit more myself, and so I thought that would be a great sort of follow-on topic today. So I'm going to talk about just what is ATR, kind of define it, maybe see how we can use it as a base sort of unit to gauge volatility. And then we're going to look at a couple of indicators that use average true range as part of their equations and their calculations. And then we're going to show just a couple of scans and alerts that we can use to maybe incorporate some of this into searching for stocks, either on the buy side or the sell side, stops, all sorts of things like that. Let's see, I'm going to go over here. And I'm not going to go into the super nitty-gritties on average true range. It was created by Wells Wilder, who created RSI and the directional ADX. So he's created a number of these sorts of indicators. And it's basically a measure of volatility, as you can see in this little chart here, that uses the previous close and then either the current low or the current high. So it measures volatility from day to day. It then averages that over some time period, and then it takes an absolute value. So average true range is directionless. It's not like there's an up range and a down range like there is with the ADX. It's just a simple volatility. It's just a number. I invite you, if you really want to dig into it here in Chart School, we've got all sorts of issues about how it's calculated, spreadsheets, the whole workup of information that we have in Chart School. So I will leave those who want to get into the nitty-gritty to take a look at that. But we can sort of take away from this, and what I'm taking away is average true range is just a unit or a dose of volatility. I'm going to switch over here to a micron chart, and we can plot ATR as an indicator. You can see I've added ATR down in my indicator area here. The default is 14 periods. I use 22 because 22 is about the number of trading days in a month, plus or minus. It's close most of the time. And so I like a 1 month is sort of a nice range to look at things. And we can see here over the year that volatility does move up and down throughout the year. You can sort of see this in the candles there in this area here where we came up, hit a high here, and we dropped fairly significantly in the space of a few weeks. We could see the true range increasing. And then recently, when we started sort of a little bit more consolidation, we start to see the range going down. And one of the things Dr. Elder talked about was that average true range is just sort of the normal behavior for the stock within a period of time. Some stocks are going to have a higher volatility, so you're going to see things like if you were to take a look at, say, some of the 2-3x inverse ETFs, those super juiced ETFs are going to have much higher ranges. Maybe some stocks such as biotechs and some software companies are going to inherently have a much higher volatility and range than something like, say, maybe a 2-year corporate bond fund that's going to be pretty constrained. So this sort of just gives us a flavor for what the default volatility is. You can sort of think of it as maybe one ATR is sort of like a resting heart rate for this period. Of course, we can have things come in and change things. We have earnings will be sort of an outside force that will send the stock in a large direction volatility-wise. We've got geopolitical and economics. So, but in a short term, we can sort of think that this is a reasonable estimate for where we would just expect the normal up and down of the market to fall within this range. So the first little nugget I got from Dr. Elder's talk was that he said you should never really set your stops very close to a low, a recent low. So if we're here, you might say, well, let's see, this is, I'm going to guess that's around, say, 45, 75-ish. It says you probably don't want to set your low at 45 or your stop. Because right here we can see that our expectation of just the general volatility is $2.40. So given this range here, say the previous month from this point, you could expect about a $2 up and down ride there. So he says if you're setting your stops very close to that range, it's probable that you're going to get stopped out almost all of the time just from regular market volatility. So his suggestion was when you're setting your stops, set it at least 1.5 ATRs from a recent low. That will show you if you hit the 1.5, then you know you're seeing abnormal volatility for that sort of range, time range that you're looking at. And that's kind of where you want to think about trying to get out. You don't want to get stopped out because you're just in the average range. So his first takeaway, and he stressed this, really you want to set your stops at least 1.5 to maybe 2.0 ATRs away from a low to just not get stopped out instantly. And so the first item I'm going to show, and Dr. Elder as well as Arthur Hill looked at this, and this is the Keltner channel. There we go. And Keltner channels are similar to other channels. They basically define a mid-range, a middle of the road item here. This essentially is in this case a 20-day exponential moving average, and then it defines sort of a width, and the width used by Keltner are ATRs. Probably one of the other most popular, of course, is Bollinger Bands. It also uses a moving average as its center line, and then it uses standard deviations as its top and bottom width. But the goal of the channels is essentially the same whether using Keltner or Bollinger or EMA channels, is that most of the time the stocks will stay within a certain range, and it's when you get inside or outside the range that things become interesting. And Dr. Elder, let's see, we'll just go over here and look at the parameters on our list here. So Keltner's, we've got a 20-day exponential moving average. We're going to use 2 Keltner channels or ATRs as the width. And then over here we've got our period for our average true range. I'm going to update that to 22 so we have the same parameters as our average true range that we got down on our indicator. So now we've got a channel around this moving average that are 2 ATRs, so we'll call that like 2 units of volatility. And we can see up here in the chart, we can give our range for the upper and the lower. And if we go over here and you were to do the math and subtract this range and divide by 2, you would get this value down here. So you can see here with Micron that it does a pretty good job, but we do have a fair amount of time spent outside our 2 ATR values. So what we can do is maybe go up to a 3, and that's what both Arthur Hill and Dr. Elder used, was a 3 range ATR. So we can see there that a little bit better at capturing that notion that once we get past a certain point, we will snap back to the mean. And this sort of says that if you've really got 3 levels of ATR, 3 levels of volatility, that's when you can really expect to start seeing some moves back to the mean. Dr. Elder used this. Dr. Elder, of course, his background is in psychiatry, and he likened this to the market being manic depressive, and such that there are times when the market goes crazy and everybody's just looking to buy, and there's all sorts of buy interest, and it just kind of gets out of hand in one direction. And then there are times when the opposite happens, when everybody hates the stock. It's in the doghouse. Nobody wants to own it. It's just a complete washout. And he used this range as sort of a level to see when he wants to buy or sell something. He would sort of go counter trend. He would say, okay, when something gets down here and everybody's just dumping it, nobody's interested in it at all, he may look at saying, so, okay, we've punctured this 3-level ATR. That may be a good place to buy, to start looking at a buy. If you've seen, maybe it's, if you can throw in some support here and there at the same range, you can get sort of an idea of like, well, we've obviously, if we come over here, we had support at 46. We had a top here, it looks like 46. So maybe you could say, we punctured the 3 ATR range here. We came through some support. Maybe this is not a bad place to go. He would then, I would imagine, he would say, okay, I'm not going to set my stop here. I'm going to take my average true range, which we'll call that $1.80, and multiply that by 1.5. We're going to come up with about $3 and change, $3.40 something. So we maybe would set our stop about $3 or so underneath this, maybe 45.75. So we may be down in this range here, and that's where he would set his stop, and then he would just let the trade go. He would then start to say, okay, when it really gets crazy, so if we had this penetrate down here, and maybe if we'd gotten down in 38, let it go for a good run, and maybe when it starts to get crazy, get out. I mean, in this case, if we had a full drop down below this third ATR level here, we'd let it run, and we'd have got up to 38 to say 50. Maybe if we kind of hung on and just put some closer stops, we could have ridden it all the way up into the 60s. So this is a pretty good case here where that ran pretty well. I would imagine that Dr. Elder would say that once you get into a trade, you may want to adjust if you've got a significant profit, then you may want to think about shrinking your stops up, because you really don't want to lose your profit. But maybe in the beginning of a trade, you want to give it a little bit more room to form a range. You don't want to get stopped out right off the bat. And I know that's something that's certainly happened to me, and I imagine it's happened to you as well. So the idea of using this average true range and sort of a default level of volatility to try and, in the initial parts of the trade, just keep you in the game. And then if it goes outside of that range, you can really say, I really gave this enough room and still got stopped out. It was just the bad time to be in the trade. So it's proving to be a nice system. I'm trying to incorporate that into some trading and see how it works out. Arthur Hill also came up with a system for trading. He back tested, and again, one of the sell signals for him on the upside was this penetration to the upside of the 3 ATR channel. Again, same sort of idea, is that once you get up above this channel, it's really doesn't stay there very long before it snaps back. So like, Tom, you were mentioning the Qualcomm. You get to a point where you think, this could keep going, but there's some signs here that this may be the place to just take your money and run and wait and see if you get a pullback, and you can decide if you want to wake back down, get another drop below this. I know Dr. Elder had talked about writing scans where you may look specifically for Keltner closes to go below the third Keltner. So that may be an option if you're looking for these sort of quick dog trades where you see something kind of crash through the bottom and you're assuming that you're going to get a quick bounce. Maybe Dr. Elder talked about maybe just writing this up to what he called value, getting back up to the center line as just a very quick in and out. 2 or 3 days, you may have made $6, $7, $4 or $5. Just take little trades and do them very frequently. So that was another one of his suggestions. So that's the Keltner channel. Some people will create sort of rainbows with Keltners. We'll do a 2. We can kind of do this ribbon effect. We can have a range there, so some people will plot multiples. You can take these and turn them into areas. We'll maybe do a blue, and we can change the opacity. This kind of creates a shaded range. So there's some options you can use there to kind of do different displays of the ranges of the Keltners. So maybe if you're deciding, well, maybe I want to use 2, maybe I want to use 3, you can kind of plot this on a particular stock, and like I said, it will sort of develop a signature. You can kind of see if a 2 range is better suited to getting you in and out faster or more frequently, or if the 3 range is really what you want because it is much more of a wider deviation from the mean, and with higher probability of snapping back at some point. So we'll take those off, and then we'll move over to some Chandelier Exits. Again, Chandelier Exits using a 22 period ATR and 3 units. And the Chandelier Exit, it's called an exit, but what it really is designed to do is just to keep you in the trade and follow the trend. As you can see here, we had a great uptrend here, and if you had used the Chandelier Exit as a stop, which basically uses a 3 period ATR, it's calculated, and I'll again refer you to Chart School for more details, it's calculated as 3 ATRs from the high within the 22 period range. So it would take 3 ATRs from probably this spike up here. So that's how it calculates it, and it's designed again to keep you in the trade, show you that when something finally crosses it, you're getting 3 units of volatility. That's, as we've seen with the Keltner Channels, that's considered an abnormally large amount of volatility, and maybe that's when you want to think about getting out, is when you start to see volatility creep up to a sort of a scenario where it's out of character for the stock. That's maybe a time to think about getting out. And here's a pretty good illustration. We got a pretty good run here. We had a big drop down here, a big sell-off in February. I can put some volume on here maybe. Let's see if we had a big volume drop. We had some fair volume on there as well. Came back up, and then we basically followed this trend. And if you'd stayed with the Chandelier Exit, you wouldn't have got this top. But by the time we got here, we've seen a pretty sizable downdraft. We've got from 60. If you take this bar all the way down, we've had like an 8.10 or 12% drop in 3 days. So that would have been a pretty good time to have to run for the hills if you'd managed to stay in the trade from here in the upper 30s to low 40s. Again, here we've got a good run here. We don't quite capture some of it. It's a pretty good range here to get out. It kept you in the trade all the way until we had this gap down. So this can be used as a couple of different ways on the long side. We've just sort of shown when we cross below, it's a good stop, it's a place to get out. You can sort of use it on the flip side as well as a signal to when to get in. So when we're looking on this on the sell side, we're looking to see when the close crosses below the Chandelier Exit. A buy side sign may be when we cross above the Chandelier Exit, because now we've gone from sort of a case where we were a little bit of in the doghouse, and we've finally crossed above. We've managed to reverse this volatility that we've seen here. So we've had all this volatility that dropped our value, and then we're finally starting to level out, and we're starting to come back up. So we might want to have a scan that will show us when we've crossed above the Chandelier Exit as a point to get in. And in this case, this illustration, it worked pretty well. I mean, if we've crossed in there, we had a little gap up here, a little island there, and then we got in around 48. We would have rode it up here, and even with this pretty sizable down drop, we still had a good almost 10-point run in the space of a month. So, and that's not bad, 25%. If I could do that every month, I'd be a pretty happy camper. We've seen it drop here. We had a little bit of a fake on this one, but then here when we've dropped out, again we had a pretty good drop, and now we're just back in this mode. We've just crossed it, so it'll be interesting to see how this unfolds as to whether we've got another trend starting here or not. Chandelier Exits have a couple of components. One is the long, and one is the short. So we can do a short version of this, and this would basically be the opposite of the longs. So this would be a case where if you were shorting the stock and we cross above it, that's again defining a new trend. This is going to be 22 periods from the low, or 3 ATRs from the low of the 22 periods. So here we've got a case where we've crossed above this. It means we're basically in a new uptrend, and if you're shorting something, an uptrend is the last thing you want to see. So this may be a point where I'm going to get out of my shorts. I'm going to close the shorts. I'm going to get out. The character of the stock is changing. I've let it go up all the way up here, and then we've got a pretty good turnaround, and we've let our ATRs finally catch up. So this is when we go through this on the downside would be maybe a place to put in a short. We've had it come back up. We didn't quite cross it. Again, came back down. We crossed it above here. In this case, the short, you'd have been out flat. This case up here, we had a cross below. We were shorted. We came back up. We didn't quite hit a full uptrend, and then we came back down. If we'd, depending on how long you would have stayed in the trade here, it would have worked fairly well. We still would be short from this point here up at 60, because we still, if you've kind of, depending on what you decide to do with this, we're still below it, and we're still looking to kind of cross and form a very good uptrend. So you can use the Chandelier Exit. It's called an exit, but really it's gauging of a trend. And you can use it on the long side or the short side. So with that, let's go up to our dashboard, and I'm going to run over to our, oh, it's nice to see a little bit of bounce back in the market there. We're going to look at our advanced scans, and I saved one here called ATRs, and we'll try and scroll this out just a little bit. I put a few examples in here of how you may want to use both chandeliers and Keltner channels. And like I say, these can be dual purpose. One can be if you don't own it and you see a cross above it, it could be a buy signal. If you do own something and you see it below, it could be a sell signal. So you can switch the order in the scans here. The X there means cross above. So when we see the close cross above a Keltner channel, there we've got our 20 period moving average, 3 Keltner units, and 22 period. That may be a point where Dr. Elder would say we're getting manic, and so maybe want to cool off and take our stock and run away, as he said. And he had some great lines, but one of them says, "I don't like to travel with manic people. If I have to be around manic people, I'm going to need to be paid." And that's where you're getting paid. You're up there with the manic people. It's just time to take your money and go. We've got some other options here. Our Chandelier Exit, the long crosses below the close. So we can reverse the order. Instead of crossing above, this means crossing below. So this is a case where we had our Chandelier Exit was following us up a nice uptrend, and then the flavors changed. We started seeing some more volatility, and maybe this is a point where we've punctured the chandelier, and maybe it's time to get out. And the rest of these are just variations of that. So using the same options, you can change this here from a long to a short if you want to change that direction of the chandelier to decide if you're looking at being a short versus a long. And that's basically what was presented that I saw from ChartCon, and that's how I've kind of researched it and started playing around using it myself. So I'm curious to see how this works. I'm most hopeful that Dr. Elder's insights about the stops will be a very valuable thing.
All right, well, that was a great presentation, Bill. I know that probably there are a bunch of folks who have seen the ATR and Keltner channel and so forth, the Chandelier exit strategy, all of that, but I think you did a really good job in a fairly short period of time of pulling it all together.
Thank you.
So that was an excellent presentation.
I was one of those who, of course, I've seen a lot of these, but this was the fact that so many people mentioned it in the under the general topic of risk and risk mitigation and volatility being a proxy for risk, that I thought this is some interesting stuff. So while everybody was gone last week and I had some time to kind of play, I dug into this a bit and started trying to use it myself.
Well, I got I got one question in particular, and that is, I know that you were using the 3 ATR range,
Mm-hmm.
and you were looking, at possibly, I guess checking out a range. And of course, I'm looking at it and trying to decide, okay, is that something that I could use in my trading? And I'm sure everybody else, when they're watching, is thinking the same thing. So, and as I watched it on a couple of those charts, a stock continued to stay within that range in a downtrend.
Yes.
So it never really went beyond that 3 ATR to the downside. Like, yeah, I mean, on this chart,
Right.
I mean, 64 back in May, and then it's at 46 in August, and yet the entire time it stays within the 3 ATR. So I guess just for clarification, are you suggesting that somebody, if they're in the stock, would continue holding that? Or are you saying only look at it when it hits the top and the bottom of these ranges like it did in August at the bottom,
Right.
where it was support? What,
Well,
can you
that
just
was
kind of
the
interpret that?
present what I saw from Dr. Elder's and Arthur's presentations, that they saw those ranges when they punctured those as places to get in or get out. If you get in at the extreme down end when everything's pessimistic, and you can ride it to the point where it gets above this range, then that's a pretty good signal. But yes, it does stay within this range, and even this the Chandelier Exit, maybe three is too much, because this is a pretty good range. I mean, if I owned this thing, if I bought here or something, and I saw it go from 62 and on its way down to 48, I wouldn't have probably withheld this downdraft here. That would have just scared me. I'd have probably been out. So I think it's doing actions at the edges, is what Dr. Elder and Arthur Hill used as, if you own something and it gets way up above the third range, it's probably a good time to get out, because things are getting kind of crazy. And Dr. Elder used it also as a point to get in as something being completely washed out. But it is a very wide range, and volatile, and it's a moving range. You can see here the range here was almost, well, not quite double. We're still heading down. So clearly there are times when the volatility can peak, and that of course sends these ATR channels even wider.
Yeah. Well, one of the things I get out of this is that you can use this, but I would use it as a secondary indicator, not a primary. In other words, if it pulls back and hits the bottom of this range, I'm not just going to say, oh, I'm going to go buy the stock.
Right.
But the fact that it's hitting it when it's hitting a key price support, that sort of thing, kind of adds some credibility to the trade. Would you agree with that?
Yes, and I think like a lot of technical indicators, there's no single thing. I think it has to be a series of things that are somewhat unrelated. Obviously, you don't want to use 3 indicators that are derived off the same type of data, because they'll all give you the same flash and go signal. Dr. Elder used the force index, which uses some volume to see like if there's a big washout, or if there's a big, like this point here, you can see the volume went off the charts at the same time. So we had this huge updraft, and that's what he's looking for, is a huge updraft on big volume. A lot of times that's not sustainable when it's this far out. And so I think he and Arthur Hill sort of noted that this scenario is just a good place to really think about getting out.
Yeah, and I think you made a really good point that, you're trying to find indicators that maybe look at that particular stock or the overall market in a little different way. I mean, if you're looking at it only using momentum oscillators that are based on price and have nothing to do with volume, then they're going to begin to tell you the same thing. But on the flip side, you also have to be careful that you don't get so many indicators that you can't, that you're paralyzed and can't make a trade, because half of them are saying buy and the other half of them are saying sell. So it's really that, you're trying to find that middle ground where you've got indicators that you trust and that kind of make sense that they go together. If you will. So it's always good to have you on here, Bill, and kind of go through some of these other indicators and getting such a thorough explanation. So really appreciate your time.
Sure, happy to stop by.
Always. And there he goes, Bill Shelby, another excellent presentation, this time on the ATR and the Keltner Channels and Chandelier Exits and all kinds of good stuff. Always great to have Bill on the show.